Okay, so welcome back. We're going to move on now to having discipline risk management 2. And we're going to look at further portfolio risk parameters that you can apply to your overall trading account. And we're going to look at an actionable trading plan where when you've finished the video series and taken the exam, you can actually open a trading account and start to apply all of these parameters and also the risk management rules that we looked at, or principles that we looked at in video 1 of risk management. Now, why do we put extra parameters into our trading account and not just have stops and targets on every position that we have and just keep running those positions? Well, we've got to have extra parameters or limits or restrictions, again, to stop us being human and doing silly things in our trading account, like throwing all our capital onto one trade, or even worse, throwing all our capital onto a trade that's never going to work and is showing us that it's never going to work. This is why risk management is so important. Again, it's to stop us being human, to stop us chasing bad situations and not leveraging or going after good situations and going into good situations in a way that we're still looking to manage risk well. So these overall principles still apply here. This is why we have these extra parameters, these extra limits in our portfolios. And these parameters that you're about to see are actually very, very typical of hedge fund and investment bank prop trading desk limits and restrictions that are placed on the traders, on the trading desks by their managers. The only problem is that retail trading is different. You're trading with your own money and you don't have a boss to tell you what to do and what your restrictions are. You don't have these portfolio limits that are given to you by an outsider. If they're given to you by an outsider, you have no choice, because in the professional environment, if you break them, you risk losing your job. You'll be out the door. So no one ever breaks them. But when you're sitting with the blinds closed in your office or at home and you've got your own trading account, it's a very, very different scenario, because you don't have that boss to tell you what to do in terms of your restrictions and your risk management on your portfolio. So you have to apply these principles, apply these portfolio parameters, these risk parameters, and stick to them. If you don't stick to them, you can get into a lot of trouble, because the boss really is not another human being or figure telling you what to do. The boss is the market. And if you lose money, the market's telling you that you shouldn't be doing what you're doing, and your exit out the door is actually to lose a lot of money and get a margin call if you don't actually respect risk management and implement all the principles that we talked about in the previous video, but also the principles related to having extra risk management limits and parameters applied to your portfolio. So we'll go through these now on the computer screen. I'll see you at the end of the video for a conclusion, but make sure you pay attention, because these are very, very important. You have to implement these yourselves and stick to them in your actionable trading plan. I'll see you at the end of the video for a recap. Okay, so what we're going to look at now, we're going to look at further risk management parameters that we can actually apply to our portfolios or brokerage accounts with an actionable trading plan. Now, in the last video, we covered trading psychology and the reasons why we've got hard stop losses and soft targets in place. And essentially, it's to stop us being human. We want to be doing the opposite. We want to be managing risk correctly and objectively. There's also a multitude of other risk management parameters that can also stop us being human, that we can apply to our portfolios and brokerage accounts. So when we have real live positions. So we implement risk management parameters to our portfolios to protect our downside if things go against us. And this ensures that we know our risk in our portfolio at any given time. Now, this is important because knowledge of your risk and having your risk under control gives you the confidence that your downside is protected, and then allows us to unleash the upside in the portfolio when we're presented with winning situations within the portfolio. So the parameters that we're going to be looking at here, that we're going to apply to our portfolio in order to monitor risk, keep risk under control, and keep downside protected, is the list of parameters that we've had in the overall process since you've been analyzing the overall process right through the video series. So we're going to be looking at gross exposure limits. From this, we'll be picking up along the way how to look at net exposure limits. We're going to be looking directly at single asset limits. We're going to be looking also at an overall portfolio stop loss. And along the way, we're going to be picking up how this applies to a currency only portfolio and a multi-asset portfolio. And as a reminder, this part of the video series and the overall process comes as part of the overall having discipline section under risk management. And prior to this, we obviously had a look at trading psychology, and with trading psychology, making sure that we apply stops and targets that are both realistic, and that's applied to ideas generated by the idea generation process that have also shown us good timing in terms of wanting to put the trades on. And then we apply our ATR and we apply our risk management parameters to the overall portfolio when we actually have real positions. The output later is trading statistics that give us self-awareness about our performance as traders. So again, this is just a reminder of where our portfolio parameter deployment fits in. It fits into the area of the overall process where we have real positions and real capital has been deployed. And just as a side note, you can see now from looking at our risk parameters, and also from our previous video on risk management with deploying ATR and analyzing volatility to set stops and targets due to psychology when trading with real money, you can see now why this is so important. We get a lot at the Institute where guys come to the Institute thinking, with receiving no education and no trading experience, that if they've used a demo account on a brokerage platform, that this is somehow a gauge of their ability as a trader. Well, it just absolutely isn't. It means nothing, because our risk management parameters here are all set because of trading psychology. And if you've only traded fake money in a demo account, that you've got absolutely no gauge on what you would do with real money. All you've done is learned how to use the brokerage platform. And a track record in trading is only using real money. So an investor or someone analyzing your track record with the purpose or objective of giving you money to trade is going to critically analyze your track record only if you've done it with real money. So it's an absolute waste of time to use demo platforms thinking that you're going to gauge somehow your ability as a trader. You've seen this in the area previous, so in the previous video, when we were looking at volatility, trading psychology, and how we set stops and targets and why we do it. This all applies here as well. We do all of this for exactly the same reason. And when you're trading with real money, it's totally different than if you're trading or not trading, as the case is, with fake money, theoretical money on a brokerage demo platform. So just remember that the next stage after your education is to actually learn how to implement all of this with real money. First thing we're going to look at is gross exposure limits. And we've touched on this previously in the video series a few times. We're going to go back to setting up, as we've mentioned previously, a margin account with $25,000 deposited on margin. Now, we know the reasons why we put $25,000 on our trading account, so we're not going to labor the point too much. If you go right back to the beginning of the video series in Foundation, you'll see why. Now, margin, if you remember the definition of it, it's used as collateral to ensure against any losses that you might incur in your trading account. In the UK, Europe, and Asia, leverage CFD providers are going to allow clients, so retail traders, to expose themselves typically up to 100 times in Forex. So what this means is that it's a 1% margin requirement. So you only have to put up 1% of the overall exposure that you can take as a maximum. In the United States and Canada, leverage CFDs are not available. They were banned in 2010 for the reasons of leverage. Too many retail traders were losing too much money, so they banned them. However, margin accounts are still available, and the maximum exposure rates allowed are typically lower. So typically, you would get 50 to 100 times in the US and Canada. So the margin requirements are higher. If the exposure rates are lower than that, the margin requirements are going to be higher. But check with your broker and use the spreadsheet below as your basis to calculate your risk. So we've got in the download section a spreadsheet called exposure margin. If you download that, you'll be able to get a table or several tables that are going to help you to analyze your overall risk in terms of your margin and your exposure rates. Now, whatever you decide to expose yourself by in dollar terms, the reciprocal of this number is the rate at which you're going to receive a margin call. So the number that's deposited in your account, if you take a certain level of exposure, you'll be able to work out what wipes out that amount of money. And when you're wiped out, that's when the phone rings or you get an email and you get a margin call. You have to deposit more money in your account. Otherwise, the broker will trade out of your positions and you'll just incur or crystallize all the losses. And what we want as traders is to never, ever receive a margin call. We want to have so much cushion and so much leeway that there's close to no chance or even zero chance of us ever getting a margin call. That's what we want to be doing if we're taking a professional approach. We want to ensure from our risk parameters that the likelihood of us getting a margin call is close to zero, if not zero. So in terms of gross exposure and gross exposure limits, what we want to be looking at is the amount of margin that we deposit, what our maximum exposure limits are, and the exposure limits that we set ourselves. So if we go over to the spreadsheet, We come out of the presentation, go into the spreadsheet exposure margin. What we have here is our exposure rates and the level at which we receive a margin call if we lose a certain amount. So if we're 100 times leveraged, we receive a margin call if we lose 1%. If we're 90 times leveraged, we get a margin call if we lose 1.11%, and so on and so forth. So we just take the exposure rate and we do 1 divided by the exposure rate. So if a broker is advertising to you that you can get 100 times leverage on any product, so this doesn't have to be Forex, then they're basically telling you you're going to receive a margin call if you lose 1%, assuming that you take all the leverage and go up to your maximum exposure. And again, if we scroll down to the bottom here, if you choose your exposure rate to be, say, 5 times, you're going to receive a margin call if you lose 20%. Now, if we use this principle to set up our exposure tables here in stocks, Forex, and a Forex only or combined portfolio, we can start to get a gauge on what type of risk we'd be willing to take. So in terms of gross exposure. So if we choose an exposure rate in stocks, for example, of 4 times, this means we're going to receive a margin call if we lose 25% in our portfolio. So if we put $20,000 into our portfolio and choose to be 4 times exposed, we will have 80,000 exposure. If we lose 25%, because 20,000 is 25% of 80,000, we lose 20,000 and we receive our margin call. That should be pretty self-explanatory. In Forex, we have the same table worked out. If we have our exposure rate at 8 times, we can receive a margin call only if we lose 12.5%. And if we go to putting 20,000 into our trading account, that means in Forex, if we're restricting ourselves to 8 times, we have exposure of $160,000 or equivalent US dollars, whatever currencies we have the positions in. The equivalent is $160,000. So if we lose 12.5%, 20,000 will be wiped out. So we have to start thinking smartly here around the volatility of Forex and what exposure rates we're willing to take. Because one thing that isn't an option is obviously having 100 times exposure, because all we have to do is lose 1%, 20,000 on a $2 million or equivalent position, and we're wiped out. 1% can be a few days move, maybe 3-4 days move, where a currency pair goes against you by that much in 3 to 4 days, and you're wiped out. You're receiving a margin call. If you don't stump up more money to go into your margin account, your broker will pick up the phone or send you an email, deliver the margin call, and might just even stop you out very, very quickly in order to earn the commission. Now, if we change this back to 8 times, again, remember this example here, the 20,000 deposited on margin, 160,000 exposure, that's 12.5%. Now, what we have to think about here in Forex over our 1 to 3 month time horizon is the opportunity that we're being presented by the volatility and having discipline via risk management by setting our targets, our soft targets, and our stops accordingly. So if we look at a Forex only or combined portfolio, where we have a maximum exposure of 6 times, this kind of works, because if we think of this in terms of receiving a margin call, we would have to lose 16.67% on our overall exposure number in order to be wiped out. Now, if you think back earlier to the euro dollar example, what does euro dollar represent as a currency pair in the overall ATR rankings? Well, it's a very non-volatile currency pair. So there's obviously a lot more currency pairs in our tradable set that have got more volatility than euro dollar at this point in time. So by representing that type of currency pair, we know from the euro dollar volatility that we looked at that this, even with 6 times, can still be a little bit risky. So we had 1 month volatility in euro dollar on a 1 year rolling basis of around 3%, and we had 3 month volatility of around 9%. So we can see that in 1 month, if euro dollar goes against us and it's our only position in the portfolio, so let's say euro dollar represents a combined overall volatility for an average across the tradable set, then if we lose the 1 month volatility in 1 month, we're actually going to end up losing 3% of the 16.6% of our entire portfolio. But first things first, we know that euro dollar doesn't represent the average. It's actually a lot less volatile than most of our currency pairs. But also, that's quite a lot of our money to lose, because if we lose 3% of the 16.67% of our overall margin, then we're going to be losing around 20% of our entire margin. So, for example, with a 20,000 example, if we lost 20% of our entire margin, we'd be losing around $4,000. So how do we counter this? Well, we could actually just reduce our exposure to overall 4 times, so we know we're with very, very low probability to ever receive a margin call, and the risk management metrics stack up better. But we could also lower our exposure rate and grow into the 6 times exposure. So when we go from, say, $20,000 margin, once we're making money, we go from, say, being 4 times or 5 times exposed with our $20,000 margin, and when we make money and go up to 30,000, we could actually increase our exposure rate to 5 times. So here we start off with $20,000 margin and 80,000 exposure. As we increase up the scale, we increase our exposure rate because we're making money. And then as we make more money and, say, go from 30,000 to 40,000, we can increase our exposure rate again. So what are we doing here? Well, if we think about our trading psychology from earlier, what we're actually doing is pulling from box A. So instead of, when we're making money in our portfolio, reducing our exposure, what we're doing is increasing our exposure. We're pulling from box A on our portfolio because it's now proven that we're good at making money, we're good at trading, therefore we increase exposure. Also, when we're thinking about stop losses and targets, when we roll stop losses on winning positions within the portfolio, we're taking less risk. So although we're increasing exposure, we're actually taking less risk because we're locking in or almost guaranteeing that we can't lose money on a winning position. So our exposure number can go up as a rate that's getting bigger relative to our margin, but actually our risk is going lower. Also, if we diversify, the more we increase our margin, the more money we make, and the more exposure we take. If we increase our diversity, so adding more positions to our portfolio, rather than having a more concentrated risk, we're increasing our exposure rate, but at the same time, decreasing our risk because we have more positions in the portfolio. And the contribution of each individual position overall becomes less to the overall outcome of the portfolio. So we're going to talk about this when we go into an actionable trading plan a little bit later. But what we need to understand and get cemented here is how we look at our trading accounts with margin and overall exposure. And this example here, it's the same box, so same formulas, same metrics as these two. So it can be applied to anything. It can be applied to a Forex only or a combined portfolio of, say, Forex, stocks, and commodities. So you can apply this across all asset classes. The key is to look at this number here, the margin call number, and look at the volatility of the asset class that you're trading and work out the sensible exposure rates and to have an actionable trading plan. So in your own time, go through those numbers and compare them to ATR rankings and make sure that your actionable trading plan is realistic and disciplined. Fortunately, we have a solid actionable trading plan for you here as we're going through the examples. The example here is to set up a typical margin account with $25,000 deposited on margin. And as ever, we obviously want to give ourselves a chance of making money. So we self-impose our own gross exposure limits so we don't ever receive a margin call. Now, professional traders usually trade leverage CFDs in stocks at around a 5 times exposure rates, and that is assuming a well-diversified long-short portfolio on a 1 to 3 month time horizon. And they will have in currencies between 6 to 8 times and commodities at 4 to 5 times. Again, assuming a well-diversified long-short portfolio, and most of the time the portfolio will be multi-asset class. So the portfolios will have stocks, commodities, Forex, and even interest rates, bond exposure. However, to get to that point, they have to be making money first. And they apply a principle that when making money, they allow themselves to increase their exposure rates because they've earned the right to commit more capital. When losing money, they reduce exposure because they've not earned the right to continue running the same amount of capital as before, or even more capital. So what you have to look at here is treating your portfolio as if it's an asset in itself. You don't throw more money at an asset that's losing money. You only throw more money at an asset that's making money. This is the same principle as before in trading psychology when we discussed the boxes, box B and box A. Box B is to reduce exposure overall in your portfolio. Box A is to increase exposure in your portfolio. The principle here is that when you're making money, you have the right to commit more capital because you've proven to yourself that you can make money. And now you started trading, you started trading with less. So let's say you started off with $20,000 and now you've grown your portfolio to $28,000. The extra $8,000 that you've now made is the house's money. You're now playing with the house's money. So you have less risk as you start to increase your margin and your portfolio. You have less risk of getting an overall margin call on the initial deposit that you made into your account in the first place. And when you're growing your account, you protect your downside the same as you did before. So you keep building your exposure and keep building the amount of margin in your portfolio. And here, with analyzing our gross exposure limits and having an actionable trading plan, we're going to allow a maximum of 50% of our total margin to be deployed to currencies or Forex, and 50% of our total margin to be deployed to equities and commodities, or a mixture of the two. So out of the margin that we've deposited, the $25,000 in this example, we're going to be allowing a maximum of $12,500 to be deployed to currencies, and $12,500 maximum will be deployed to equities and commodities in period one. And when we mean period one, what we mean is when we start out, when we haven't made any money yet. If any money is made in the portfolio, we're going to allow ourselves to pull from box A, and we're going to allow ourselves to increase exposure rates. So in our overall portfolio, you can see here that we're beginning to build out an actionable trading plan using gross exposure limits. If we started to apply rates to these numbers, then you'll be able to work out both gross and net exposure to our different asset classes. So for example, if we had a 5 times exposure rate and we had $25,000 in the portfolio, then our overall gross exposure on the portfolio is going to be $125,000. And our net exposure to equities, commodities, or a mix of the two is 62,500. And our exposure or net exposure to currencies is going to be $62,500 as well. So we're splitting our exposure, our net exposure here, to 50% towards each asset class. Now, we can apply our exposure rates that professional traders deploy or expose themselves to, and the process that they go through to build their exposures. So first of all, we're assuming a well-diversified long-short portfolio across Forex, equities, and commodities with $25,000 deposited as margin. We're assuming 50% split down the middle in terms of net exposure, and we're assuming a 5% return before increasing the exposure rate. So let's go through this now. In step one, we're putting $25,000 into our trading account. We're yet to make any money. We're yet to lose any money. So we have to apply an exposure rate that gives us a chance of making good money in a well-diversified long-short portfolio across Forex and equities and maybe commodities. Gives us a good chance of making money, but is not ill-disciplined enough where we're going to receive a margin call very easily. We want to ease our way in to building our exposure and make money along the way. So here we have $100,000 exposure, $50,000 in Forex, and $50,000 in equities. We have 8 to 10 positions at any one time, both long and short. And we've applied a 4 times exposure rate because we have our $25,000 in the account. That means we can lose up to 25% before we receive a margin call, which quite frankly is almost impossible if you're running 8 to 10 positions in a well-disciplined long-short portfolio over 1 to 3 month time horizon. If we're going to move to a higher exposure rate, we're going to be moving only if our margin increases, only if we make money. So we're looking for a 5% return on the $100,000, which gives us a 20% return on the $25,000. And then we're increasing our margin from $25,000 to $30,000 because we've made $5,000. So your trading account, the margin in your account gets credited as you're making money. And this happens at the end of every day. Your account is either credited or debited, your margin balance depending on whether you make or lose money. And then when we have made 5%, we increase our exposure rate because our margin has now gone up to 30K. So we now increase our exposure to 5 times the 30K, which gives us $150,000 exposure, $75,000 exposure in Forex, $75,000 exposure in equities. We've also increased the amount of positions in our portfolio, which is very key because as we're growing our exposure, we're taking more gross risk, but we're actually taking less net risk because our exposure in Forex is gross 75, equities gross 75, but that 75 in each asset class is split amongst more positions. So our net exposure to asset classes is actually decreasing in terms of overall risk. This provides us on a 5 times exposure level a 20% cushion, so we can lose 20% before we actually receive a margin call. But because we've increased our diversity in our portfolio, the likelihood of that happening is the same or less as it was before. So very unlikely. As we make money, so we're looking for the 5% return on $150,000 exposure, we grow our margin from 30K to 37.5K because we've made 7,500 in the portfolio and our margin account is credited 7,500. Then we can start to ratchet up and look for increased exposure to 6 times. Don't forget here, we're now playing with the house's money. So we can look to protect, we want to look to protect the $5,000 that we've made and ratchet up and increase to 6 times exposure after we've made another $7,500. So now we're up over 10%, we're up 10% on exposure overall, but our returns are going up in not a linear fashion, but more of an exponential fashion because we're increasing our exposure and our exposure rates as we're making money. We then move on to our 6 times exposure, and this is really the maximum exposure you should be taking if you're taking the same approach as professional traders. And that's on a combined Forex, equities and commodities portfolio. On a Forex only portfolio, you can probably add 1 to each one of these exposure rates. So 5 times starting out, 6 times if you're making money, and 7 to 8 times if you're making really good money and you've been consistent and done it well for a good period of time. So around 9 to 12 months. You have to have a good, strong track record to be here. If you're taking 6 to 8 times in currencies and overall diversified long-short portfolios across asset classes. So when we get here, we have our 16.7% cushion, but we've actually increased our positions again. Gross exposure of 225,000, Forex 112,500 net exposure to Forex, and net exposure in equities to 112,500 as well. So you can see how this works now. We start off small, we ease our way in as we prove to ourselves that we have the ability to make money. We increase our exposure rates, and instead of having linear returns in our portfolio, we end up seeking or having close to exponential returns or better than exponential returns. This is what we want to be doing. And the principle we're sticking to here is we've got box A all the way as we're increasing. We've also got box B where we are applying risk parameters to our portfolio, where overall we know that if we stick a stop loss on our entire portfolio, where at any one time we can't lose more than a certain amount of money given the percentage moves, then we know we're pulling from box B if things go wrong. However, as we make money, we have no restriction on our portfolio except our exposure rate of 6 times. So we want to be increasing our exposure as we're making money and as we're winning in the portfolio, so we can unleash the upside in the portfolio. But we also now want to add extra risk parameters to our portfolio in order to protect our downside, so we know if it goes wrong, we're pulling from box B. However, before we add these risk parameters to our portfolio, we're going to look at how the metrics work in terms of margin and margin requirement as we're going through the process of building out this portfolio. So in the above example, if we assume a 1% margin requirement on Forex and a 10% margin requirement on equities and commodities, so what's typical in the UK, Europe and Asia, we'll have committed the following amounts of margin. So in step 1, we have 50,000 Forex exposure plus 50,000 equities and commodities exposure, therefore giving $100,000 gross exposure. Our utilized margin on Forex is 1%, so we're utilizing $500. On equities and commodities, it's 10%, so we're utilizing $5,000. So it's said that overall we're risking $5,500. Our available margin is simply our initial margin, $25,000, minus the margin that's being utilized. So the number that we're risking as part of our margin, so $5,500, leaving $19,500 of margin that currently isn't presently utilized. However, we know that's there because we're choosing our exposure rates and we're making sure that we never receive a margin call. In step 2, we have $75,000 Forex exposure and $75,000 equities and commodities exposure, giving a gross exposure of $150,000. The margin that we're utilizing is $750 in Forex and $7,500 in equities and commodities. So in total, in step 2, we're risking $8,250. Our available margin is $30,000. So the beginning of step 2, what our margin is, minus $8,250, what we're risking, leaving $21,750 as our cushion never to receive a margin call. In step 3, our Forex exposure is $112,500 plus $112,500 in equities and commodities, giving a gross exposure of $225,000. The margin that we're utilizing towards Forex is $1,125 plus a 10% margin requirement in equities and commodities, so utilizing $12,500. So $12,500 there. So in total, we're risking 13,625 US dollars. That's the portion of the margin we're risking. The available margin is the margin that we started off with at the beginning of step 3, $37,500 minus what we're risking, $13,625, leaving $23,875, which is our cushion against a margin call. So you can see here that as we're making money, we're increasing the amount that we're allocating towards risk. So risking 5,500 out of 25,000, 8,250 out of 30,000, 13,625 out of 37,500. So the proportion of margin that we're risking increases. We're pulling from box A. However, we're actually decreasing risk as well, because in the example, we're actually increasing the amount of positions and diversification. So as money's made in the portfolio, we're allowing ourselves to pull from box A and increase exposure rates. But at the same time, we're always leaving more than enough room to have a bad day, a bad week, a bad month, because we know that our real risk is actually our exposure and not our margin. As we increase our risk, it makes sense that we increase positions and increase diversity, but also we might want to apply a stop loss to the entire portfolio, where as we ratchet, we actually protect the money that we've made as we're increasing exposure and exposure rates. So in a moment, we'll be looking at applying another risk management metric or parameter to our overall portfolio, and we can have a overall portfolio stop loss. So applying the same principles in terms of having a stop loss to a single position, we can also apply a stop loss to our entire portfolio in order to protect the money that we're making as we're building the portfolio and as we're taking more risk. But first, we're going to look at single asset position limits and why we have those and how we can actually deploy them as another risk parameter. So single asset position limits, what does that mean? Well, it's putting a limit in terms of a proportional limit on one position versus the rest of the portfolio. And we do this in percentage terms. And the reason why we do this is because we never want to be in a situation where one single position in our entire portfolio is creating the entire destiny or outcome of our portfolio. So by doing that, we ensure that if things go wrong on one position, the rest of the portfolio doesn't get hurt, or the overall portfolio doesn't get hurt by too much. So imagine a situation where you lose on a single position, but you have a limit that stops you from going above a certain amount on that position. Well, it just means that that one position, if your limits are sensible, can't hurt the outcome of your portfolio. But if you win on that position, you can actually build an exposure in that portfolio that is above the asset position limit and protect the money that you've already made. So, for example, in step 1, we had the $100,000 exposure portfolio, and that was split equally, $50,000 or 50% to an equities and commodities portion in the portfolio and a Forex portion. So in the equities and commodities portion, if we put a 10% portfolio limit, but single asset position limit on any one stock, so equity or commodity, we would basically have a $10,000 limit whilst we had gross exposure of $100,000. That $10,000 is 20% of our $50,000 net allocation to equities and commodities. And we can also apply a starter position limit of $5,000, so a 5% overall portfolio single position limit on a starter position for any one position. If we look at the Forex portion of the portfolio, our $100,000 exposure, we can apply a 25% single asset position limit to any Forex currency pair, which means whilst we have a $100,000 gross exposure, we have a $25,000 position limit on any Forex pair, which is 50% of our net allocation, the $50,000, to the Forex asset class. If we apply the same principle as before, in terms of half our position limit being a starter position limit, then in Forex this would mean $12,500 as a starter position, or 12.5% of the overall portfolio as a limit for our starter positions to Forex. Now, we can also consider a Forex only portfolio. Here we've considered a combined portfolio of equities and commodities and Forex, and our allocation was 50% to equities and commodities, so that portion of the portfolio, and 50% to Forex. But we can also consider a Forex only portfolio and consider a single asset position limit on any one currency pair when we look to take that position. So we can apply a single asset position limit in a Forex only portfolio of, say, 33%, whereby we have a 33,000, approximate 33,000 limit on any one Forex pair at any one time. So with a gross exposure of 100,000, that means we want to be having a minimum of 3 positions or 3 currency pairs at any one time. Now, the reason why we can have a higher single asset position limit in a Forex only portfolio than a combined portfolio is that the volatility in Forex is lower, and we don't just want to have one position or 2 positions. We want to still increase diversity, or we still want to have diversity, but we can have a higher concentration in percentage terms because the volatility in Forex is lower than in equities and commodities. Whereas in an equities and commodities and Forex combined portfolio, we want to obviously allocate to where volatility exists and therefore where opportunity exists. So in this example of a $100,000 Forex only portfolio, we're looking to have some diversity where we have a minimum of 3 positions, and therefore we have a 33% single asset position limit. Now this means we'll also have a starter position of half that, of 16.5%. So $16,500 when we initially take a starter position. And this works out quite nicely because on a max 6 times exposure portfolio, this means you'd have to lose 100% on a starter position in order to get a margin call, which is basically very, very close to impossible in the Forex markets. So if you remember earlier when we were looking at our exposure rate tables in risk management and looking at the levels to receive a margin call, this would mean that you'd have to lose 100% on a starter position, which is close to impossible. Now, we talked earlier about single asset position limits and how breaking a limit might be possible if you actually have a winning position. Well, that's fine. You take the positions as either a starter position or a full position size, And if you go through your soft targets, you can increase the single asset position limit on that particular winning trade, as long as your stop loss is either above or below your average price in a long or a short, in order to protect the actual money that you've made to that point. Now, of course, you still have gap risk. If you don't want to have that, then you don't have to break limit. You can just run the trade. But you can also increase the exposure and apply a single asset position limit to winning trades. Now, on this theme of protecting money as we're making money and building the portfolio, we can also apply portfolio stop losses. So, for example, with our $100,000 exposure portfolio in step 1, with our $25,000 deposited as margin on account, we can have a 20% portfolio stop loss. So 20% on our margin, not on our exposure. So if we lose 20% in our entire portfolio, so 20% of our margin, so $5,000, what we're saying to ourselves is we will trade out of everything and we'll take a break and reassess. Note here that the exposure level on this portfolio is $100,000, so it's 4 times the available margin. And what we can do here is we can work out that if we divide our portfolio stop loss of 20% by our exposure rate, so the 4, we actually get the percentage stop loss on our overall gross exposure, our overall portfolio. So that works out as 5%. So what we're saying is that if we lose 5% in our overall exposure, or we lose 20% of our margin, when we're 4 times exposed, we're going to actually trade out of everything and take a break and reassess. So if we apply this situation as we're growing the portfolio, then it means that as we're increasing our risk and we apply a portfolio stop loss and we're ratcheting the portfolio, it means that we're protecting the money as we're building the portfolio and as we're making it. And the principle that we want to stick to here is each step that we go through is that the portfolio stop loss that we stick on our portfolio is basically protecting the money that we've made in each step. Because as we're making money and building the portfolio, we're taking money out of the market and the market is paying us, and we don't want to risk our own money. We want to protect our own money and protect the money that we're making along the way. So the stop loss should, in a similar way to when you protect your long winning positions and your short winning positions, with a stop loss that's either above average price or below average price, you want to be taking the same approach with a portfolio stop loss and protecting the money that you make along the way. So that brings us to the end of portfolio construction parameters. Let's go back over to the desk for a quick recap. Okay, so welcome back to the desk. Again, what you saw there in risk management 2 is really important stuff. We first obviously looked at the importance of gross exposure limits, so limiting your total exposure in notional dollar terms within your portfolio. And setting a gross exposure limit is the same as setting a leverage limit. So we went onto the computer screen, we looked at the leverage sheet with exposure and margin, and we worked out what our downside is if everything goes wrong and where our tolerance levels are for receiving margin calls. So we work within those parameters by setting gross exposure limits. We also looked at net exposure limits across asset classes. So we looked at a multi-asset class portfolio with equities and commodities and Forex. And we also looked at a Forex only portfolio. Now, the reason we obviously believe that gross exposure as traders is the most important thing is because we realize that our real risk is our gross exposure and not how much the broker tells us we are risking. So we don't listen to that. If a broker allows us to leverage 100 times, that doesn't mean it's right. We know there's a conflict of interest. This goes right back to the beginning of the video series. Our margin is there as collateral to ensure against losses, not there to abuse, to take more leverage because it's available. We also then looked at single asset limits, so within a portfolio, restricting how much we actually have on any one position at any one time, unless we have a big winner in the portfolio, which gives us license to then open up and break our limits as long as our stop losses are ahead of our average prices and we're managing risk well. Now, when we set single asset limits, what we're essentially doing is diversifying. So for example, if we set a 10% limit in our portfolio on any one position, what we're actually saying is, on the flip side, the reciprocal, is that we have to have a minimum of 10 positions in our portfolio at any one time. And this principle of diversification is pretty important, because what you want to have in your portfolio is a situation all the time where if something goes wrong, another position can actually pay for a losing position or make even more. So having this negative correlation in your portfolio is quite important. Now, the other principle that we looked at was the principle of when we increase our gross exposure as we're making money and we increase our exposure rate, is setting a portfolio stop loss. And the portfolio stop loss principles are exactly the same as the principles that we've looked at previously on stop losses, whereby as we're growing the portfolio, increasing our exposure rates as we're making money, we're setting a portfolio stop loss in order to ensure ourselves that we're protecting the money that we've made. Now, in reality, as you're growing your money, growing your exposure rates, and growing your overall exposure, and you're increasing your diversification, you're probably going to have some big winners in the portfolio that are contributing in quite a big way to the overall profit in the portfolio. So in reality, what will happen is that if you're managing risk well on those individual positions and you're rolling your hard stop losses in front of your average prices, what's going to happen is that those stop losses will be the first risk management trigger in case anything goes wrong on the big winners. So that will actually protect your profit anyway. But you always have to have a portfolio stop loss in place outside of that, because something else might go wrong in your portfolio. So it's a very important principle to have, that you've got to have a portfolio stop loss that protects the entire portfolio in case something else goes wrong. So all of these principles, you've got to get used to applying these in your actionable trading plan. So please go out there when you're starting to implement this after you've taken the exam at the end of the video series. When you go out and implement this, try to set all of your parameters up so you're optimizing your risk management. And going back to the first video, having discipline 1, risk management 1 in this section, make sure you stick to all of those principles and never forget, and always understand why we have risk management in place, so you always respect risk and have discipline. It's very important. And as I said before in the previous video, it's as important to be good at managing risk as it is in generating good ideas and getting on good trades at the right time. You've got to manage risk well. Otherwise, you can have good ideas, time them well, but something goes wrong and you don't respect risk. You go arrogant on a position and you average losers and always trade out of good positions. And that will just lose you money over time. You want to be doing the opposite, sticking to the principles, adding to winners, cutting losers, and managing your risk well in your overall portfolio by deploying sensible, common sense metrics that manage your money and protect your money from factors that are out of your control. Okay, so enough on risk management. Now, please do deploy the actionable trading plan. It will stand you in good stead and it will make you consistent over time, assuming that you have a good pipeline of ideas coming through and you're timing these optimally. Let's move on to the next part of the video series now, which assumes that we've started to take positions, we've now traded in and out of positions, and we want to actually analyze ourselves as a trader. Let's move on to self-awareness statistics, and I'll see you on the other side.